My name is Andrew Romans. I often like to say, who came the furthest from to get here? Anyone from Japan or far away?
Singapore.
Australia. Very good, very good. Even more important is those that made it from San Jose, because that's always really rough. From Japan, fantastic. Wonderful, wonderful. I was actually born in Kannagawa, U.S. Naval Base. But quick on the agenda, and I'll make some introductions and we'll get started. So I'm Andrew Romans, 7VC Venture Capital. The agenda for the evening is we're going to have a VC panel with these guys and get through about 30 minutes. Maybe we can shorten that and then open up to 15 minutes for questions. I just ask that the questions are questions and not statements and not pitches of your startup or has to leave. There'll be plenty of time to try and pin people down in the networking to pitch your startup. And then we've got 4 bullet 7-minute pitches without questions. And again, lots of networking where you can run up to these guys. Of course, in a law firm, no one is selling a security. There's no one soliciting to invest in anything. But having been in this business for a long time, they tend to raise a new fund every 2 or 3 years. Some of our startups tend to raise a new round every, maybe 9 to 18 months, and even a quick round can happen after a round closes. So if you're interested in investing in these guys, you can find out about them. And with that, I say, let me welcome Brad Rock. I've got a long history with DLA Piper. Curtis Moe is the guy that we've been working with for just so damn long. Brad was even saying, Curtis Moe is not even Curtis Moe. I mean, he's just famous. I jokingly say he's a investment banker masquerading as a corporate securities lawyer because he knows everybody to get your deal done. They've seen every possible outcome to a good and bad situation, and he's wonderful. And if you're in San Francisco, this is the man to talk to, and so thank you for hosting us.
Hi all, great to see you. Thanks for turning out on a winter night when it might have rained, and I hope everybody had a smooth travel here. I'm Brad Rock. I'm a partner here in the San Francisco office in our corporate department, and if any of you don't know us, DLA Piper, we're one of the 2 or 3 biggest law firms in the world with offices all over the world. But although we're a big law firm, we still love working with startups and with the venture ecosystem, and have been doing that, forever, with roots going back to Silicon Valley in the 60s, as one of the indigenous Silicon Valley firms became part of DLA Piper. So love hosting events like this and seeing you all. Sogol, my colleague, is in the back of the room, and we love talking about deals and about startups. So look us up after the session's over, and welcome.
Thank you. And just on that topic, I have to say too, it's good to be very disruptive with technology and business models, but not with your Series A financing or your convertible notes. So I think it's a good, like when we know the name of the lawyer, not just the law firm, that's a plus. Maybe that'll be a question for the panel, and you guys can all disagree with me on that. Laura Ennis from Fidelity. Fidelity acquired Shoebox, which I believe competes with Carta.
You stole my opening line. I was going to say Laura with Fidelity, the new Carta, the better Carta. Thanks, Andrew. Laura Ennis with Fidelity. Historically, you guys probably think of Fidelity as a mutual fund company or servicing public companies. But we recently acquired a company called Shoebox in January, Boston-based, to compete with Carta, Pulley, and other cap table providers, and to be able to support founders, investors in this ecosystem. So we're super new. Love that you guys are here. Thank you for having us. And come find Holly or myself to talk to us about cap table, data room, financing, just helping support you guys. So thank you so much. Appreciate it.
Thank you. Okay. So let's get into it. So thanks everybody for braving all the crazy things with the Apex Summit. Seems like it's not as bad as it seemed. We'll see how easy it is to get home. I still wouldn't leave your laptop in plain view anywhere in San Francisco or any city. But why don't you guys, Ben, why don't we start with you and we'll come straight down. Why don't you guys introduce, so we don't kill too much time, try to go for under 60 seconds, your firm, what stage do you invest in, what are your core sectors, what geographies? Ben Levy.
So hi, my name is Benjamin Levy. I'm a co-founder and general partner at BootstrapLabs. We lead and price seed stage round. We co-invest at Series A. We have investing in AI for the last 8+ years, so we didn't start yesterday. We have about 29 portfolio companies, 8 exits, and about $1 billion in follow-on funding in our portfolio. We like to apply AI into 6 verticals: future of work, mobility, health, digital infrastructure, financial infrastructure, and climate and energy. I think that goes there. And US only in Canada for now. That's it.
You don't love France anymore?
Love French founders that are outside of France that want to come here.
DPI France will pay you all for that. Carolin.
Yeah, hi everybody. My name is Carolin Funk. I'm a partner at Blueberry Capital.
And can you guys hear us, or should we attempt to be passing this microphone around?
Microphone.
Okay, here we go. Great.
Hi everyone. My name is Carolin Funk. I'm a partner at Blueberry Capital. Our focus is investing in software and data-centric technologies where energy, infrastructure, or climate are one of the end markets. Our typical check size is 3 to 5 million. So first check is usually late seed to early Series B. Geographical focus is North America and Europe. And within Europe, I say we really like investing in the beer drinking countries. Countries, so sorry, Ben, with the French founders. And yeah, we define energy and climate really broadly. So anything that enables, unlocks, accelerates the energy transition, not just in the wind, solar, and in energy storage grid spaces, but even manufacturing software that accelerates the build of electric vehicles, or even space tech that helps with getting new data sources that where we can track more emissions or water use or energy availability.
Hi everybody, Vibhor Rastogi. I lead AI investments and co-lead our Asia practice for Citi Ventures. Citi Ventures stage agnostic. We invest about 200 million per year, 2 to 20 million check sizes, and we invest in tea-speaking countries.
Hey everyone, Victoria Cheng here. I'm a partner at PruVen Capital. So we are an independent venture fund that is backed by the largest global financial services and insurance companies in the world. And they actually serve as our value-added platform, right, for the founders in FinTech, InsurTech, enterprise IT who are looking for a partner to help them co-create new products, do distribution, or just want to get into the vertical of financial services and insurance. We're the partner for you. We invest multi-stage, so seed to Series C. Our check size range from a few $1 million all the way up to $30 million per company, and I'm excited to be here.
Ben Black, Akkadian Ventures. We provide secondary liquidity across the venture ecosystem. Deal size up to 35 million, and the stage is growth stage, so it's like typically around 50 million in revenue. It goes early as 10. I wear a second hat too because I run a conference called Raise Global, which brings together emerging managers with limited partners who want to sort of find the next generation of great venture capitalists.
Great conference.
Yeah, and I think I was at your second event in Citi. You know, it was long. How many years ago was that?
We're on 8. We just did 8.
You just did 8, so I was at number 2.
Yeah, it's amazing.
That's great. That's great. And Victoria, you looked at that you were at Citi Ventures before, so you're rubbing elbows. How long were you at Citi?
Oh my gosh! I mean, my partners and I were at. So we were at Citi Ventures for like a decade building that platform, which I don't even know, it was 165 or something like that. So we've been investing in FinTech and InsurTech before. It was like super cool. You know? Like, everyone's like, oh, every venture fund's got a FinTech partner. It was back then. I was like, I really wanted to invest in this space, and like nobody wanted to like invest in that space. I didn't care about it.
Well, I think it's like B of A Merrill employs more IT professionals than like work at the Indian railroads, and so a strategy for Citi Ventures was just to sit outside the IT department and see if they just give a purchase order to some SaaS company, and then maybe invest in them. But so we're gonna have to pass this microphone around. But why don't we start with where is the market right now, and we can get into where is the market right now by stage. But like, for example, I've got people emailing me to sell me secondaries in companies that I invested in at like an 8 and 10 and 12 million valuation pre, to offer me like 86% below the last unicorn pricing, you know, of it. So there's been like crazy drops in that. But then again, that secondary, is it really the next primary round? But Ben, why don't you kick us off of Where's the market right now? Are pre-money valuations going down? Are they going up? Are certain industries tailored to cities? Where do you see the market right now?
So, we're in the AI space, which is supposed to be the hottest one right now, but we've been investing for a long time, and even 7 years ago, we saw the $80 million pre-seed round, right? We didn't invest in that. You have to be disciplined, you have to manage the font size. I think the seed rounds today actually are itching up in valuation a little bit, and I think that's the result of a couple of things. One is, only good companies are getting funded, and when they do receive this sort of interest, then everybody wants to pile into them because they're going to have the runway and they're going to be one of the few funded companies in the space. So I think you see that price dynamic a little bit, like a bit of FOMO and few quality teams getting funded, and therefore you want to be jumping on that one as opposed to not. And as a lead investor, we don't jump into this FOMO type of phrase that either we want to do the deal or not. And frankly, we're very disciplined in terms of valuation and target ownership. So we don't let the market dictate where we invest and come in. Does that mean we're going to miss some? Yeah, possibly. But I think in order to be a good venture capitalist, you just can't blow your model out. Especially if you want to have repeat fundraising strategies.
And Ben, what stage are you talking?
Sorry, I'm talking
seed,
seed, really seed, and look, the Series A 10 years ago was inflating to $10-15 million. Now we're back to 5 to 7. I mean, you take your pick what a Series A is these days. I think what is not changed is the bar constantly keep evolving up is, scalable product market fit. Right? That's what you need to get to if you want to be a Series A company. And you need to have a certain amount of momentum and traction. And I feel like people say, oh, I have $1 million, therefore I have $1 million ARR, therefore I'm going to do a Series A. I say, that doesn't mean anything anymore, right? Because people may have $2 million, people may have $500,000. It's the velocity and how you achieve that revenue that's more important than ever before.
Yeah.
And so it's a noisy market out there, so I think it's hard for founders to just stand out. So valuation on the early stage, inflating. Late stage, to your point, it's pretty ugly. Very hard to raise, later stage rounds, large rounds. And people that raise in 21, 22, they're just struggling. And I think Ben is in a much better position to talk about that than me.
Yeah, and Carolin,
Yeah.
all of our European LPs were like, why don't you pivot to do nothing but clean tech? I'm like, what? You think that's going to save you from the winter after Putin invaded? But where do you see your market? Is more money coming into your space? Is more money flowing out? What are you seeing on valuations?
Yeah, I think, there's definitely more money flowing into the space. I just read a number that now investing in clean tech, and we can have a whole session on defining what that actually means, is more than 10% of the total venture capital investment in the US. I think it's actually last quarter just surpassed 12%. So it's going up. More folks are investing in that space. I think we see the same thing on valuation that Ben described. Like seed Series A rounds are still pretty, depending on company fundamentals, not much going down, but later stage for sure. And there's a lot of activity in Europe because there's more certainty around some of the regulation. A lot of that space is regulatory driven or informed in some way, shape, or form. And
But
so,
the exit landscape hasn't changed much though.
no, the exit landscape, and that's why the earlier stage investments are still pretty juicy at this point. Because the exit landscape, especially in clean tech, they're just mostly M&A to large corporates, and they've been holding their checkbooks close to their chest. So agreed on staying disciplined and also underwriting for the right return multiples. And if you're a founder, just do the math yourself. Like what do you think your venture capitalist will want to get out of this at the end, and what's your exit view, and where can you go from there? We don't have lots of IPOs in that space. We have some SPACs in clean tech, and they're all terrible.
Right. So, Vibhor, maybe rather than repeat the same question, maybe we ask.
What does the math have to be for the math to work? Like, if a pre-money valuation of a pre-money startup in the spring and summer of 2021 was hitting 100 million, what do you have to exit at to satisfy some losses, some flat, some staff, and get a cash on cash in the end that would satisfy Mr. Ben Black over here? Like, what does the math have to look like for entry points and multiples from you guys?
Yeah, I mean, the math just doesn't work, right? So 2021 vintage will probably be one of the worst vintages of all time, right? It will be like the 2000 vintage or the 2007 vintage. It will be one of the worst vintages that we will have ever seen. So the, to the point that was just made about Series A, so seed valuations kind of the 15 million post-money, that's kind of where they're hovering. Series A valuations in the 40 million sort of range. And then the C's, D's, and E's, they're down probably 30 to 40% from the peak. But the secondary pricing, which I think is a fairer price, that's down 80%. And I think that's more realistic. If you look at what Instacart or Klaviyo priced at, especially Instacart, they've all taken a 70-75% hit to their last private valuation. So I think the public market investors are frankly showing a mirror to the VCs who were holding onto their dear life at these valuations. And I think the other thing is, there's a lot of bridge rounds that are happening. I think a quarter of the rounds are bridge rounds. There was some structure that you were starting to see for the math to work. So multiples of liquidation preference, some participation. We ourselves have participated in a couple of those rounds. So I think you'll see more of these sort of structured financing for the math to work. But until the valuations come down by another 30-40%, the math just doesn't work.
Yeah, and Victoria, maybe you don't want to answer a question like this. Some people are hard to get a straight answer out of. But what about this math on how to land on a valuation? If a company's got $3 million of ARR and they're a red hot AI SaaS company, adding logos like crazy, landing and expanding, is there like a sensible multiple of ARR in your mind, or how are you pricing companies in today's market?
It's an evil question. Because
It depends on the
you're damned
company.
if you do and you're damned if you don't, and answering that in front of a bunch of founders.
How many people are even founders here?
Yeah, great idea. Let's go.
Okay. So a lot of you probably are interested in this. How many are just VCs? So the rest of you guys? Okay. Yeah. See. So it depends on the company, right? Like I know it's like a total cop out, but like that it's true, right? So I think that in today's world, and actually more maybe than some of these guys that will speak. Actually, you probably can speak more to the AI side. So like I'm mostly do FinTech and InsurTech investing, which is like actually pretty great right now because those valuations are like much more reasonable, I think, than they have been historically. But it depends, right? And in those really hot spaces, I'll tell you that there's still a lot of capital outstanding, right? There's still a ton of dry powder. And everyone is trying to get into this, like, this flight towards quality, whatever quality means, but basically this flight towards, like, hey, what are still the opportunities that everyone still wants to be a part of? And, like, AI is the hot new thing. So, like, in AI, it's like that game, right? You go to one of these offsites and they say, okay, everyone, like, hold out your finger, you're going to, like, hold onto this board, nobody raise your, like, finger, and, like, the board keeps going up and going up. It's like, I'm not doing it, and everyone says, oh, I'm not doing it, but somehow it rises, right? So I think you still see that especially in this like generative AI space, which is why now every company is company name .ai. It's the new like .ai.
Can I take a crack at this? Yeah. So we priced a deal like that earlier this year. So that company was doing about 3. They are at 8 now. May finish the year at about 10. We priced it at
ARR?
ARR, yeah. So we priced it at 45 pre, 60 post. So that was the market price. So my very first venture deal was with Curtis Mob. Yeah. So at DLA, and that company went from 1 to 5, and we did that deal at like 20 pre. So that was the market. This is in 2011. So that was the market at that time. The best in class companies were trading at 5 times ARR. Like Salesforce, people were like, oh, that's crazy. Salesforce trading at 5 times ARR. Yeah. And that's where multiples are now. I mean, public SaaS multiples are back at 6 times, 7 times ARR. If you're best in class, you maybe get 10x, 11x, 12x. But a median SaaS company that's growing at 20%, 25%, 30%, the median multiple is 6x ARR. So it's flight. I mean, it's reverse to where markets have always traded, and that's good.
But to be fair to the startups, to be the G in a discounted cash flow,
you've got top line, bottom line, and growth. right? So what is the growth that the publicly traded companies are delivering? And what's the growth that Ben Levy's portfolio is delivering year on year? So if you really blow up G, that will have something to say. But then again, if Zoom was 47x ARR, I like to tell people, so if they had $1 million in revenue and I bought it for 47 million and there's a zero discounting of cash flows, it'll take me 47 years to get my money back. Even if there's any kind of inflation at the same time, which is blowing up, then that's insanity. I'm waiting to see if increase of interest rates enters the minds of venture capitalists. Ben, you want to say something? Because I want to get, we got Ben and Ben, two Bens.
I mean, look, 10 years of investment banking, repentant investment banker, so I get all the math. But, at the end of the day, you need to be a long-term fundamental investor when you're in venture. And you need to swing for the fences for those companies that will own the majority of the market. So, you can optimize on the margins. Yes, today it's finally